All right, let's move on to our companies and talk about Charter Communications. And this is just another one that I don't understand. It kind of blew me away what happened today or this week. But let's look at the numbers to see what's going on here. Charter Communications, symbol CHTR. They're in the industry of telecom services. Wow, 15.5% is a short. So a lot of people think this stock is going to go down. Institutional owned about 78%. Good PE ratio 11.9 versus 12.2. Price of sales 1.1, about the same as the industry at 1. Price to book value of 3.7 versus 1. I will point out there is no price to tangible book value for the company or the industry, and that means you take away all the intangible assets, well, no value to the company. Price to cash flow looks good, 4 versus 4.9, and the PEG ratio also looking very good. I don't get this for a cable company. PEG ratio only 0.6, which means you're not paying very much at all for the future growth of the company. Surprised here again, and we don't look at these numbers ahead of time. Their earnings per share growth over the last year was 16%. The industry, 48.6%. I thought cable was declining. Where are they getting this from? Maybe we'll find out that out when Chase talks. Sales are up 0.9%. Industry up 2.6%. Surprising number here from the analysts. 5-year earnings per share growth estimate for Charter, 18.5%. Where's that going to come from? I don't know. They do not pay a dividend. The balance sheet, a little bit risky here on the current ratio. It's a 0.4 versus 0.9, same as a quick ratio. That kind of worries me because if they start missing payments, they could be forced into bankruptcy. And the debt to equity, I'll look at the balance sheet while you're doing your thing, Chase. 5.9.
Whoa.
That is really, and there's no franchise here that I know of. I don't know anything special.
Financing? I don't think they finance equipment or finance cars or anything like that.
Yeah, so, something strange here. Oh, here's another bad thing. Intangible assets, 65%. So that means there's, again, well, we talked about no price to book value after you take those out. Net profit margin does look good, 9.4 versus 8.9. Return on equity also looking pretty good, 32. About double the industry at 15.7, and they do have free cash flow, about 4.3 billion versus about 8.4 for the industry. So, what do you got going forward? What are you going to give me here?
Yeah, so current price here for Charter Communication, again, their ticker symbol is CHTR. It's $427.25. I got to say, I'm surprised by the performance of the stock.
Yeah.
The 52-week low is $266.06. 52-week high is $437.06. I mean, year to date, the stock is up about 25%. Over the last year, it's up over 54%. Over the last 5 years, it has struggled a little bit during that time period, down about 17%. But I mean, the 10-year return is really not that bad, 139% over that time period. So I thought this stock was going to be a terrible performer, but I'm going to say it's done okay. And going forward, I mean, the valuations still look quite good. December 2026 estimated earnings per share, $45.02. Gives you a target sell price of $747.33. Stock trades under 10 times those future earnings. I say there's excitement here over valuations, but I just can't justify this stock with the balance sheet.
You know, I think there's 19 analysts, others that agree with us because the range of estimates, the high is 51.93, the low 34.16. That always gives us a worrisome thing because, wait a minute, why is it not closer than that? There's something else going on here. I think you had something else on it too, didn't you?
Well, I mean, the big thing, the reason we wanted to look at this was they were in the news this week. I mean, they announced a huge deal. They're actually going to merge with Cox Communications. That agreement values Cox, and Cox is a private company, at $34.5 billion.
You said merge or buy?
Merge. They say merge. I think it's essentially buy. But
okay.
The way it works out is $21.9 billion of that is equity and $12.6 billion of that is net debt. So the concern here is Cox has $12.6 billion of debt on their balance sheet. That's going to add even more debt to Charter's balance sheet, which could make it even weaker. And the other concern I have here is Charter's been kind of on a spending spree. They did announce it would acquire Liberty Broadband in an all-stock deal recently, and that merger with Cox is expected to close around that same time as the merger with Liberty Broadband. So, I mean, you're potentially going to be integrating all these different assets at once. I would imagine that would kind of be a little bit of a headache.
And we do spend, before you invest in a company, 10, 15, 20 hours looking at things because I'm not getting this at all. Looking at the balance sheet, you're not going to believe what their debt is. $93 billion.
Wow.
That's a lot of debt. And also deferred tax liability, another liability, is $19 billion. So you add the two together. I mean, they owe over, almost $110 billion. I mean, that's just crazy. And I don't know, are we missing something on this company that they do that is a growing business, that's growing the earnings, We did not look deeply at what the company does, but I just saw it's a cable company.
Well, I mean, obviously, internet. I mean, we use Spectrum. I mean, we use it business side. I used to use it personally, but I switched over to T-Mobile internet. Not a plug. I don't like T-Mobile stock. I'm not a T-Mobile salesman, but I've been very happy with the T-Mobile internet, and it's way cheaper. But anyways, you use it personally. We use it at the business. We use it for phone and internet here. I think you use the TV side of it as well at home. So, I mean, they have that. One thing, too, is I know my brother Nash, he's got a phone through Spectrum, and that is one thing I guess that they've really been pushing quite hard. I was kind of surprised by this. If I can find the number, I believe it was, here it is. Charter said it had 10.5 million mobile lines as of the first quarter after reporting another quarter of growth. So it seems like they're trying to push even harder into that business. Maybe that's where the growth is coming from. I'm not sure, but there's maybe that positive side, but you just can't, I think, justify it as I'm going to say conservative investor like us because the risk is so high with that debt load.
And I think what I'm missing is that I'm stuck in years ago thinking this is strictly a cable company. You brought some good points up. Internet. You talked about also too.
It scares me with Starlink. I mean, Starlink's coming into the picture, and then I think Amazon, or not Amazon, but I think Jeff Bezos is trying to invest in it with Amazon, and there is formidable competition, and you have your traditional wireless carriers like I brought up T-Mobile. I mean, there's more people trying to get a piece of that pie. AT&T is another one trying to attack that internet space,
which is true. And then you also brought up that they do cell phones. 12 million people.
Over 10 million.
Over 10 million. So, I mean, they are going different areas. So, yeah, I guess you have to look at how much is the cable business declining, and they seem to be offsetting that. But they are buying Cox Communications, which, again, also has internet, but also has cable.
Yeah.
So, if you're going to look at buying these, keep in mind that high debt they have, you really got to understand this company because it could be a great investment or it could be a terrible investment. And I think that's why the big range I talked about with the earnings, they're all aboard from 31 to 51, I think it was.
Yeah, and there's a couple other interesting things that I thought were strange, I'm going to say. So, with this deal, they're actually going to change the name to the company to Cox Communications.
Wait, so Charter's going to go to Cox Communications?
Yes.
Really?
Charter's going to go to Cox Communications within a year after the deal closes, but then Charter Spectrum will be the brand on its cable, broadband, mobile, and other services. So it's going to be Cox Communications from a business, but Charter's still going to be the consumer option, which I'm like, well, why don't you just change it to Cox if that's going to be the name of the company? It's a pretty recognizable name. But the other thing I wanted to point out that could be dangerous is Cox Enterprises will own roughly 23% of the combined company's fully diluted shares outstanding. If all of a sudden they don't like that direction, let's say 3-4 years from now, they start selling off stock, that could be a big problem, is that's a huge percent of the outstanding shares that would depress the stock price. I generally don't like when ownership is that concentrated, obviously.
I mean, we wouldn't be dealing with this company because of the high amount of debt that they have. But, and again, you bring up the good thing about the risk with the competition from Starlink and others. So the stock has done well, but I just still don't like it, and I would slap a sell on this.
Yeah, I would say if the balance sheet was cleaner, I'd be interested. But I'm not even going to waste my time looking at this company because I was kind of intrigued until you said, 5.1 was the debt to equity or 510%? No, not even worth looking at. That is way too risky in my mind.
Oh, and then I forgot to mention the cash, $796 million in cash.
There's got to be something on that balance sheet where there's got to be short-term investments or something else.
And remember, the current ratio is what, 0.4.
Yeah.
So they could have a liquidity problem. They're doing some great things, but they could have a liquidity problem where they have to file bankruptcy to restructure. So be careful of it. I mean, right now it's looking great, but yeah, I'm just not excited about it. So.
No, I'd agree. I'd agree with your sell rating there.
Okay.